Before we look at the intra-group consolidation journal entry for dividends, where it's a partially owned subsidiary, I quickly want to revise some of my NCI principles. Remember, my non-controlling interests are equity participants in S. They only exist in the group, so if I want a balance measured for them, I need to write consolidation journal entries. The first consolidation journal entry that I write for NCI is at acquisition date, where I attribute the equity of the subsidiary to the parent and NCI. The parent's portion gets eliminated against the investment by the parent as common items, and NCI is either measured at fair value or at their proportionate share of the net assets of the subsidiary, represented by the at acquisition equity. So what I'm doing there is I'm moving some of the equity of the subsidiary to the NCI balance. Then I have to measure NCI since acquisition date. What I do is I take my TB opening balance of retained earnings. From that, I have to deduct the at acquisition balance because the at acquisition retained earnings gets eliminated. It's not allowed to be in the group. That leaves me with the movement in the retained earnings since acquisition date. That movement is also attributed to the parent and NCI. If the NCI needs to increase with a positive movement, I need a journal. And the same for any negative movements. In the current year, I do the same for the current year movements in equity, and the movement we've worked with was profit for the year. And this profit for the year as an equity movement of S is also attributed to the parent and non-controlling interests. Again, I have a journal to account for that increase if it's a profit to non-controlling interests. This enables me to calculate a closing balance for NCI by taking the at acquisition amount, adding to that the movement since, and adding to that the profit attributed to NCI. But now when we have a dividend declared by the subsidiary, I have a further movement in equity in retained earnings during the current reporting period, and that is the negative movement of the dividend declared by S. Now, this dividend must also be attributed to the parent and NCI. Remember that all equity movements are attributed to the equity participants. The dividend declared to the parent eliminates against the other income recognized by the parent as an intragroup transaction. But what needs to happen with this portion of the dividend declared to the non-controlling interests? With the profit declared to non-controlling interests, we increased their balance. Now, with the dividend declared to them being a negative movement in the equity of the subsidiary, the NCI balance needs to decrease with that portion. As I've said, NCI changes as the equity of the subsidiary changes. On top of that, the profit attributable to NCI is what they are entitled to as equity participants, so it increases their balance. When the dividend gets declared to them, they get a portion back of what they are entitled to. And that portion that they now received as a dividend would reduce what they are entitled to, so it will decrease their balance. Just remember this visual representation when we now look at the actual consolidation journal entry. Let's now apply what we've learned with an example where the dividend declared by the subsidiary was 10,000 Rand, the parent owns 70% and NCI is 30% equity participants. We said when the profit is attributed to NCI, it would increase their balance, and the decrease in equity of the dividend declared would decrease the NCI balance. Let's write the dividend consolidation journal entry. First of all, the parent's 70% portion. That would be a debit to dividend income coming from the parent for the parent's dividend income recognized of 7,000 Rand. The credit to that is the dividend declared by the subsidiary to the parent, 7,000 Rand. What would we do for the 10,000 Rand declared to the non-controlling interests, for the 30%? We have explained that the debit would be to non-controlling interest because the equity of the subsidiary decreased, NCI would also have to decrease with their 3,000 Rand dividend. The credit to that is also the dividend declared by the subsidiary for 3,000 Rand. What we're ultimately doing here is to move a portion of this dividend declared by the subsidiary to the NCI balance. What is the net effect of this consolidation journal entry on the dividend declared by S? How much am I eliminating in total? It's the 7,000 Rand there plus the 3,000 there. So you can now see that the full dividend declared by the subsidiary was eliminated with these consolidation journal entries. And that would result in faithful representation in the consolidated statement of changes in equity. Because if you eliminate the full dividend declared by the subsidiary, you are left with any dividends declared by the parent. And that would be the only dividend attributable to the owners of the parent. The dividend income received by the parent, which is intra-group, gets eliminated, and my NCI balance changes with their proportionate share in the change in equity of S. Remember, when writing your consolidation journal entries, you want to achieve something. If you know what you want to achieve, it's easier to remember and easier to understand. So, intra-group dividends by a partially owned subsidiary is summarized as follows in your textbook. The consolidation journal entry is applicable if the dividends was only declared and not yet paid would be as follows. The first one I've now explained in the previous discussion. Just note that this is the net journal entry where the dividend income by the parent is eliminated against the dividend declared by the subsidiary, and the non-controlling interest balance is debited because of the decrease in the equity movement. Please note this is exactly the same effect of the previous example. If you want to add amounts, you will see that the debit to dividend income will be for the 7,000 Rand. NCI will be debited with the 3,000 Rand, and they only have one entry for the credit to ordinary dividends declared by S for the full 10,000 Rand. You are more than welcome to write your consolidation journal entry in this format. But now the question is about the shareholders for dividends. Remember, when the dividend has not yet been paid by the subsidiary, it's still owed. There's still a liability, shareholders for dividends, coming from the separate financial statements of S, and there's a dividend receivable by B from S that also represents an intra-group balance. But for purposes of the consolidation journal entry, for eliminating what happens inside the red block, how much would you have to eliminate with your second journal, where we debit shareholders for dividends and credit dividends receivable by B? Would this now be for the full 10,000 Rand dividend or only for the portion owed to the parent? Remember when we looked at the representation, Non-controlling interests are outside of the group. So if the subsidiary owes an amount to non-controlling interest, that would be seen as an amount owed by the group to a party outside of the group. It's not an intra-group balance and it does not have to eliminate. So your second consolidation journal entry in this regard would only be for the 7,000 Rand shareholders for dividend and dividend receivable, which is an intra-group balance to eliminate. What would your consolidation journal entries be if we're still looking at an intra-group dividend declared by a partially owned subsidiary, but we assume that the dividend has been declared and paid during the current reporting period? Your first consolidation journal entry will always apply. The moment the dividend was declared by the subsidiary, there was dividend income recognized by the parent. The fact that it has also been paid does not change this first consolidation journal entry that you have to write. It's exactly the one we saw on the previous slide. It's the dividend income of P of 7,000 Rand that eliminates against the full dividend declared and paid by S, and my NCI would decrease with their proportionate share. But remember, when the dividend is now being paid, there's no amount owed anymore. No liability in the separate financial statements of S, and no debtor dividends receivable in the separate financial statements of P. If it's not in the separate financial statements being your starting point, there's nothing to eliminate. This would then be the only consolidation journal entry regarding the intra-group dividend.